Group, and you might as well just give it and go to financial planning. So we are one of the business units in the ING Group, and what do we do there? We provide independent financial advice, we are customer-centric focus, and we have style wealth managers. Gotta give ourselves some credit. And we work with a lot of service providers, as you can see. They are all leading global financial institutions that will give you the credibility and the reliability. So what is the agenda today? We're going to talk about what is MPF, ECA, how does it work, what is the current MPF scheme, and what are the choices in the market, and how do you grow your MPF without an extra penny. That would be very interesting. And the last one, obviously, how can professional managers like ourselves enhance your MPF? Let's start from your MPF. I look at all of you here, I think you are in the average of like 25, I would say. And that means you have like around 40 years to compound your money. So consider that you put, let's say, $2,000 a month. Well, the total contribution will be around $1 million. And let's aim high here. So let's target at growing into $1 million US. Is that doable? I say that's very achievable. So let's look at what is MPF and ECA. MPF is the Mandatory Provident Fund, and it is composed of three parts. First one is the employer mandatory contributions, which is 5% of your monthly income. Second part is the employee mandatory contributions, which is 5% of your monthly income. And the last part is your personal account from the mandatory contributions from your previous employments. So ECA, it is the employee choice arrangement, and what is that for you? Transferability. Now, what is the difference? Before ECA, the whole MPF scheme is not transferable. After that, the money from your part, that is the employee contributions, can be transferred once a year at your own choice. And the other part, which is your personal account, can be transferred anytime, anywhere. Let's look at your current MPF scheme. You have two service providers. They are HSBC and BOC. And the scheme we have selected is called Super Trust in HSBC. Inside this scheme, you've got 5 fund choices, namely Conservative Fund, Guaranteed Fund, Balanced Fund, Hang Seng Index, and the Growth Fund. Well, let's look at the performance. What we would do is to compare that of HSBC to the peers in the market based on their past 10 years performance with a monthly contribution of $2,000 or a total of $240. What is peers average? It is the average performance of the funds in the same sectors. And we'll be looking at the DCA return. And what is that? It is the dollar cost averaging annualized return, or the annualized return of the accumulated fund balance during the selected period. So this is a very interesting chart. As you can see, different funds has different performance. Obviously, the green line, which is Hang Seng Index, gives you the highest return of 9.06%. And I want to look at the bottom one, which is the guarantee fund. It gives you 0.87%. In the middle, we've got growth fund, 5.29, balanced fund, 4.96, and conservative fund, 1.29. It is not the percentage that I want to emphasize here. There are a few messages I want to share with you from this chart. Volatility, profitability, and suitability. And what am I saying here? If you follow the green line, you can see that it is actually the one that has the most movement. It goes up and down the most frequently, and the rate is the biggest. And what does that translate into technical terms? Volatility. So you can see that when the market is booming, let's say in year 2007, the chart actually goes up very quickly on the green line. And actually the rate is the biggest too. But when it crashed in year 2009, you can see that it crashed the most and it crashed the deepest and the fastest. But by the same token, when the market returns, when the market goes up again, actually the green line goes up the fastest and the rate is the biggest as well. So you can compare. From the crash in year 2009, it took 2 years, that is in year 2011, for the green line, which is Hang Seng Index, to actually over the past peak, which is in 2007. And then 2 more years in 2013. Today, you can see that it goes even higher than the last peak in 2011. So what does that tell you? The bigger the volatility, the bigger the potential gain. And I want to bring your attention to guaranteed fund. If you follow the purple line, which is almost a straight line, not exactly, but it barely moves. And the reason why is because it is guaranteed. Mostly the underlying assets are like bonds and like really, really stable like fixed income products. So it doesn't move much. So you can see when the market was booming in year 2007, it doesn't move. And when the market crashed, well, it goes down a little bit, but it's kind of flat. And then when it goes back up again, like today, when Hang Seng Index is so high up there, it doesn't move either. So it's very stable. It will not give you any surprise and will not give you any heart attack also. And what was I saying when I say suitability? It comes down to what is suitable for you. Some people who want, say, I want high risk, high return. But some people say, I want low risk and high return too. It might happen, but you're going to have an expectation that you might have to withstand the short-term volatility in order to achieve the kind of return that you want from anything that has higher volatility or high risk. So what is the main factor here when I talk about stability? One of the main factors, obviously, is age. And why is that? Because if you are 25 and you start your savings from here, you will be very happy here. And at those 2 years, you might be a little bit sad, but you know that you've got like some 40 years ahead of you to take advantage of dollar cost averaging and regain your loss and turn it into a profit. And that's what I meant by profitability. But then if you are 55 and you start from here, well, it's a little bit, kind of tough for you to handle that heartache. You might kind of like don't know whether you can actually regain your loss. So what is the critical message here? It is to talk to a professional, somebody who has the capacity to help you to analyze or to assess your risk tolerance and to look at your overall portfolio and see what you have in terms of your holdings, like what kind of properties you have, what kind of equities you have in your whole portfolio, what is your family liabilities, what is your financial objectives, and what is the kind of return that you expect, how do we match your expectations, and so on and so forth. And that's why we're here. So this is a summary of the previous chart. As you can see, HSBC outperformed the market in Hang Seng Index Tracking Fund, and it outperformed the market in its conservative fund as well. But on growth fund, balanced fund, and guaranteed fund, the market outperformed HSBC. So enough of HSBC, let's move on to your second service provider, which is BOC. You have selected Easy Choice inside BOC. And in this scheme, you've got 13 investment funds choices, and they are launched over different years. we've got a lot of choices here, you know, Japan, bond fund, Asia, European, China, CSI.